Hey guys, welcome to Let's Talk, a new episode with our special guest, Pietari Laurila. He's an elite pro popular investor on eToro, and today we will discuss several aspects about his strategy, his portfolio, and especially how he's managing to achieve such impressive performance of 37% in 2021. In 2022, when the whole market was down, he managed to end the year in green, 1.5% up. Last year, plus 31%. And this year, he's already at plus 24%, and it's just the middle of the year. So, Pietari, thank you for joining our podcast. And I'm sure Dimitri has a lot of questions. I also do. It's what is the focus on your strategy? This would be the first question actually that I would ask you. What is the focus of your investment strategy of your portfolio? If you could sum it up, basically your the sales pitch you would make to someone who has just like, I don't know, 1 minute, and he has a lot of money in his bank account, and you had to convince him to copy you, and he has a very short amount of time. How would you describe?
So my strategy is about edge stacking. So I do a lot of different types of analysis to create alpha or performance. So there's three different angles that I look at stocks from. So number one is macro analysis. I want to position my portfolio in sectors and stocks that benefit from current macro trends. And then the second step is fundamental analysis. I want to buy cheap stocks, cheaper than average in the sector. And the third angle of analysis is technical analysis. So I also have a kind of more tactical angle to my strategy. So sometimes even if I like a stock from a fundamental perspective, I might sell it just because it's not doing well from a technical point of view. And it's by combining these three different types of analysis that I believe that it's more probable that at any given time, at least one of them works. And then even if the other two don't work, then you can still get outperformance.
We will dive into the details of every of these three angles. And your username is Triangular Capital, and your website as well. So I assume it's in relation to these three angles of your strategy. When you say macro analysis and macro trends, what exactly are you referring to? Because when I look at the assets that you have in your portfolio, so you have a lot of European assets, but even within Europe, there are a lot of differences from country to country. I see that you have some assets that are located in Germany, some in Netherlands, some in Portugal, and you have also in the US. So you have a little bit everywhere. I think also Brazil, if I'm not mistaken, the Itaú Unibanco. So macro trends, what exactly are you referring to? Is it monetary policies across the globe, or?
So the first thing that I look at, and this is perhaps the most important thing, is economic momentum. Okay, so you look at leading economic variables such as the OECD leading indicator. And from that, you can see whether the economy is strengthening or weakening at the moment. And the basic idea is that if the economy is strengthening, then I want to be more in cyclical stocks, kind of more aggressive stocks, stocks that benefit from a stronger economy. Whereas if the economy is weakening, then I want to be more in defensive assets, like defensive stocks, and maybe even cash sometimes, precious metals, things like this. So this is the kind of the first part of the macro analysis. Then from a geographic point of view, you will probably take an overweight or underweight in different geographies, depending on how you see the monetary policy in that specific geography evolving, and also based on the valuation. So I've always been a value investor. So I like more kind of geographies, sectors which are trading cheap. And typically that's associated with some kind of macroeconomic problems. But if I think that there is a problem, but the situation has stabilized or it might even be improving, then I'm kind of happier to go along that sector or geography. So for some time, I've been quite long banking sector. Like my portfolio has been like very full of banks. And the reason for that is that based on my macro analysis, what I've been thinking is that the interest rates have been going up, and the banking sector is one of the sectors which benefits the most from higher interest rates. So that's like an example of a macro analysis and the outcome of that and what it leads to. And there can be quite a heavy concentration in just one sector, like based on the macro analysis.
You were heavy on Dimitri. After I will let the floor to you, but to stay on this topic, you were quite heavy overweight on financials. You still are, but I think I noticed a little shift to something more like infrastructure, utilities. One would say perhaps defensive stocks, with addition in, for example, Energias de Portugal. This is a utilities company in Portugal. Verizon, it's famous, I don't need to introduce. Deutsche Telekom, Vodafone, also RWE. So are you expecting a recession, actually? I mean, these are typical plays when you're expecting the world to crash.
My next question.
Yes. It's a very interesting time right now, and I think that we might have had like a different conversation if we had just had this chat like a couple of weeks ago, because I've really changed my macro view quite a bit in the last 2 weeks. So there's a couple of like changes that have happened. First of all, we got some weaker economic data from the US. Some manufacturing data was a bit weak. Then we got some weaker inflation numbers yesterday, which was a surprise to the market. So I've been kind of like thinking that inflation will stay high this decade for some time. So my basic fundamental view has been that the world of 2% inflation or less is gone. And this decade we are going to get more like 3% inflation. But that's more kind of like a decade-long view. So I do kind of look at the shorter-term trends also. And at the moment, I feel like the inflation problem is really diminishing. So then what I think is going to happen next is that maybe, yes, the Fed said yesterday that we are still going to get only one interest rate cut this year. But I think that, personally, I think that like that could be changing now. And I think we might be getting more than just that one cut. So because of that view, I think that like just for the next few months, interest rates might be quite stable or they might be going down. And in that kind of environment, typically the banks are not the best performers, because banking sector, it really benefits from higher interest rates. And on the other hand, like companies like utilities and telecoms, they benefit from lower interest rates. So I mean, that is kind of the reason why I've really kind of reduced the financial sector just in the last week, and I bought more into the utilities and telecom sector. Now, another thing which has happened in the last week, and a big change in my thinking, is also the oil sector. Like I had a couple of oil companies in my portfolio before. I was a bit bullish on oil, but I sold all of my oil exposure just in the last week. And the reason for that is that I like oil more when inflation is going up. Like oil is highly correlated historically with inflation. Now, if I don't anymore think that inflation is going up, then I don't really like to hold oil. Also, like another thing which actually affected my thinking is that I saw this report from the IEA, the International Energy Agency, looking at the supply and demand for oil over the next 5 years until 2030. And what they predict is that the supply is going to increase faster than demand. So now I'm starting to think that maybe with a slowing economy as well, we could get like lower oil prices going into next year, maybe down even to $60. So that's why I also like got out of that.
Yeah, just yesterday on CNBC, I'm sure Dimitri also was watching that. Just yesterday on CNBC, they mentioned that it is likely that the current US federal government will do everything they can, and they already started by releasing strategic reserves, but they will do everything they can to bring the oil price down the closer we get to the US election, which is November this year. So there could be a lot of downward pressure on oil prices also from that perspective, not only from macro weakening due to monetary policy tightening, but also there could be actually some real incentives from the US government, which is one of the largest US producers, to somehow bring the oil prices down.
And
Yeah,
one more thing, obviously, that you must have also seen in the news, like everybody must have seen in the news, is the French elections.
Yes.
So that
But
was
do you
like
think
a surprise.
do you think it has somehow an impact, the French election, and the possibility of the far right to come into the government? Because I mean, you don't have any French companies per se, but do you think maybe there could be an impact on Europe, or how do you play that one actually?
So I had a lot of French companies in the portfolio,
Mm.
like like coming into this week. Like very unfortunately, because obviously I didn't expect the election. I guess very few people expected that it would happen just now, because the next elections were scheduled, I believe, in 2027. So now what we're seeing is that the French banks have done very poorly. I got out of them because I don't like the prospect of the new government coming in. What we've seen in Europe in the past, when there's been similar changes of government towards a more populist government, is that the banks do very badly. So we saw that in 2018. There was an election in Italy, I believe around March and April, and that was a very bad time for the banks, especially Italian banks. But the reality is that whenever there's a problem in one big country in Europe, it spreads and there's contagion. And then we saw similar thing in 2022. We got a change in government in the UK, so we got Liz Truss as the prime minister, and that also caused a big drop in the prices of UK banks. So I see it as kind of possible that something similar could happen now in France. We are going to get a new government, and then the French banks will drop, and unfortunately, it will cause contagion to the rest of the European banking sector. I mean, I've seen this play a lot of times before, and that's why I'm now cautious about the banking sector. It's a tactical thing. So what I want to see is what happens with the election, and then wait for the kind of the policies of the new government to come in, and that's going to probably take a few weeks, maybe a month after the election, and then after that there might be like another opportunity to go back into the banks.
Dimitri, I don't know if you had one question you wanted to ask about the macro trends overall.
Yeah, I have a question. Let's go back to your strategy. So you have some. So you're basically a top-down macro fundamentals, then the technicals, which is similar to what I do, but I'm only in the US. So my question is, how do you manage to, because you have to know about policy and economy and elections in so many different countries. And I mean, your track record says everything. You've been beating the S&P 4 years running. You managed to be profitable in 2022, which most people weren't. Today, you are almost double the S&P. I know you compare yourself to the world MSCI, but you've been beating the S&P, which is the gold standard. So I'm wondering, how do you manage to stay on top of economy, monetary policy, politics, and everything in between in so many different regions of the world, and you manage to come on top, which to me is impressive. So
especially without having exposure to crypto or being fully invested in the US, which is one of the most which is in the top outperforming markets actually.
I mean, it's a good question. Okay, and what I believe is that in investing, it's sometimes useful to know a little bit about a lot of different things rather than a lot about just like a single or very few things. I really believe in this because if you look at some of the research done on this subject, there's a book called Super Forecasting, and they really looked academically and carefully into what kinds of people and what kind of strategies work to predict difficult to predict variables. So a good example is the level of the stock market or what a certain stock is going to do next. I mean, these are extremely difficult things to predict. I mean, there is no like single way to do it or like any formula that you can like follow. So when you're dealing with this level of uncertainty and complexity, then what these researchers found is that if you combine like multiple angles of thinking, many multiple approaches, like knowing a little bit about a lot of different things, then that's actually better than just like focusing very deeply on one kind of angle of the problem. So of course, like I cannot know very deep into like any of the areas that I follow. Like there's too many countries, there's too many politicians.
Yes.
There's too many companies. There's thousands of companies in the stock market. I mean, nobody can follow like this many companies. But like what I do is of course I spend most of my time just reading. Like most of my days spent like reading about the news. Whenever I wake up, the first thing I do is I go through about 3, 4, 5 different newspapers. So like financial publications. Then after that, I read a lot of like macro research from the banks. I read like individual company research, whatever I can get my hands on. So I mean, yes, you spend like your day reading, but it's still not enough, right? Because there's just too many things to follow. But then you gotta like focus on like different ideas that start to interest you. So let's say for the last few years I've been in the bank, so then you naturally focus more on the banking sector. You read more on that. You study the companies more. Like now I've kind of pivoted a little bit to some other sectors. So now probably for the next 1 or 2 months, more of my time will be spent reading about those sectors and improving my understanding about that. But yeah, I think the important thing is to be like open to like lots of like influence from different sources and not have any like fixed opinions. Like you can get ideas from anywhere. It can come from newspapers, from the bank research, from the internet, from some random publication, like just like following the market, like technically seeing what the stocks are doing. Like any of these can potentially be valid sources. And then you just try to make the best out of it. You're always going to make mistakes, but
yeah, of course, nobody does this and makes no mistake. And my follow-up was because I know I checked your portfolio many times, and I know you like financials. And I'm wondering, why don't you have some American banks, the JP Morgans and the Goldman Sachs and the big banks? I know you might not like the regionals, but why don't you? I'm sure you have your reasons, but please tell me, why don't you have American banks?
Why were you focused on the European ones?
The European banks, yes.
Yes, that is another good question, and there are like good reasons for that. Because you might remember the Silicon Valley banking crisis, which was there last year in March. So that was fundamentally caused by the poor regulation of US banks. So the regional banks, they were not as strictly regulated. The capital kind of rules, how they calculate their capital, they were more lax than in Europe. And so when I kind of compared the US and the European banks, then European banks actually came on top on many different levels. So first of all, they were cheaper, and like because I'm a value investor, then I always like cheaper stocks. So the PEs have been lower in Europe, and they still are lower in Europe today because of the very bad performance of the European banks over the past 10 years. But that's the past. So now you have to focus on what's happening now, what's the profitability of these companies is now, and what's going to happen in the future. And I believe like now the European banks are just as profitable as the US banks. So that has completely changed.
And you believe they will perform at least as good financially as the US banks in the future?
Yes, I do. I think the US banks, they had the advantage of slightly higher interest rates and a more stable economy for the past 10 years, from let's say 2010 until 2020. And the European banks, they really suffered from the negative interest rate policy of the European Central Bank. But now I think that's history. I don't think we are going to go back to that negative interest rate policy anymore. And that really changes the game for European banks. So yes, interest rates are coming down now from like 4%. So now they are 3.75, and then maybe they're going to go down to 2%. But I think that's more or less where they're going to go in Europe. They're not going to go to like 0%. They're not going to go to minus 0.5% like before. And And that's a massive change for the European banks.
Do you ever short because you're expecting financials to come down from the recent peaks because of high interest rates, and now the rates are going down? And I mean, by that logic, I would assume that you expect the financials would be a bit in trouble, at least their profitability in the coming years, or just you prefer to never short.
I tried shorting in 2014. That was really the last time I did it, and I wasn't very good at it. So I tried to short some overvalued companies in the tech sector, but I mean, that was like I didn't make any money doing that. So after maybe 6 months or like 1 year, I thought that maybe this is not for me. Let's just focus more on the companies that I think are cheap, that are going to go up, and not waste time on the companies that I think might go down. So I mean, that's been my philosophy like since then for the last 10 years. But I mean, having said that, you always need to kind of think about like how can you make money, right? I mean, there's no like fixed rules in this game, and you always have to think about how to improve. Now, I would be kind of open to shorting if I thought that the market was really overvalued, and at the same time the economic momentum was changing negatively. So I will never short anything just because something is expensive. I think that's totally wrong. I think that's how you go wrong very easily.
Because we started now sliding into fundamental analysis, which is actually the second angle of your triangle. Just before we really go deeply into fundamental analysis and how you value the stocks, I wanted to ask still about the allocation within your portfolio. So it's a bit more general question, not specific to stocks. You always, I mean, from the last months, because I met you, I think in November, end of October, maybe was it the PI summit? You always had a small portfolio in terms of number of assets. You always were around between 10 and 20 assets, if I'm not mistaken. And currently you have 16 assets, and it's more or less 6 to 7%, or let's say 5 to 7% that you allocate on every asset. Is this the optimal allocation? Is this the one that allows you to follow every single stock? Is this, let's say, the maximum number of assets? Let's say it's 20, otherwise you lose track on them. Is that the reason? And why do you allocate so evenly your money on all the stocks? Don't you have some preference for one stock that's, let's say, a bit more attractive than the other one?
Yes, so I don't want to have too many stocks in my portfolio, because then I feel like I lose control and I cannot track those stocks. So whenever I see portfolios of like more than 50 stocks, then I immediately become suspicious like about them, because like how can a single individual track like so many companies at the same time? Maybe it's possible, maybe they're smarter than I am, or they have more time to like track the companies. I'm not saying, but or maybe they have like a quantitative strategy, in which case it's different, right? But if you are looking at companies from a fundamental point of view, I just find it very difficult to like even like with the amount that I have, like 15 stocks more or less, is already quite a few. So to have like even more your focus on any individual company, that starts to become less. Then as to why it's about the same weight in each company, then it's simply because I've never come up with any rule or algorithm to decide like why is this company more preferable than any other company. So then I just use the simplest algorithm, which is to allocate the same amount more or less to each company. And I think there is some research to say that it's not a terrible strategy to do. So like the equal weight allocation, unless you have like very good reasons to deviate from it, then it's often very close to optimal. And when I kind of try to like, let's say, pick subsets of the stocks which I have in my portfolio, which could do better than the others, then I never be successful at that. So the stock which I think might do worse, it actually does better. Or the stock which I think will do better, it actually does worse. So that's why I just think that, I'm not even going to bother. I just put the same amount in each.
It's interesting you're saying that because I will give you the floor, Dimitri. But I read the research recently. So I work in the funds industry, right? And I read the research recently, research article about that, about the professional fund managers, how they pick their allocation. And it turns out almost systematically that about 90% of the fund managers, when they allocate more on one asset, that asset underperforms the rest. And the assets where they allocate the least, because they believe the least in, tends to be the one that outperforms the most. So essentially, professional fund managers tend to have some kind of biased allocation where they tend to allocate more on losers and less on the winners. And probably an even allocation allows you to essentially remove that risk where attractive stocks turn into value traps that can really suck the performance out of your portfolio, essentially. Dimitri, I saw you boiling there. You wanted to
No, I'm
add
not boiling.
something?
I'm just agreeing with Pietari
No,
because
I'm just messing with you.
he has 15 positions, and he's doing this as a full-time job. And he says that sometimes he's losing control. And then you see other people that are doing this part-time or not time at all, and they have 50 positions spread around the world because Ray Dalio said diversify. Ray Dalio has an army of analysts. So if you're doing this by yourself, it's one thing. If you're working within a fund and you have help, that's quite different. So, and I truly appreciate your self-awareness of just saying, Pietari, you know what, maybe more than 15, maybe I'm going to lose control. And I tried shorting, but I wasn't good at it. I mean, knowing your limitations, I believe sometimes as an investor, and just know where you're good at and where you're not. Sometimes it's an overlooked advantage that some people have, and I believe you have it, and good for you, because your performance shows. Listen, you can be lucky only so much. You're not gonna be profitable in a bear market unless you know what you're doing. But now I have another question for you. So it's the 15 around 15 different positions in your portfolio. You must have more convictions in some positions than others. So I'm sure you like one better than other. So are you still being disciplined and you're just gonna spread them? I'm sure they're not evenly exactly, but they are around evenly. So how do you deal with that?
Yes, of course, I sometimes like some positions more than others. But maybe what helps me is that I don't typically look very deep into any individual position. I follow a lot of stocks. I probably follow like 100 companies, like all the time. And what I want to understand about each position, okay, is why is it so cheap, this company? Like, why has it come down the share? What is the problem? Because a company is never cheap for no reason. The share has never gone down for no reason. There is always a reason why something is cheap. So for me, the most important thing is, what is that reason? And am I comfortable with that reason? So for example, if I think that the reason is something to do with the long-term future of the company, that this company is simply not a good company, or its market is going away, its competitors are eating its lunch, then probably I will not be comfortable with it. However, if I think that it's gone down just simply because of some temporary news, which the market doesn't like, then I will probably put that company into my portfolio. But I'm not going to get like too wedded into any single individual position. I'm happy to sell any position in my portfolio at any time if the facts change. If the macro changes, or if there's some bad news about the company which I don't like, if it reaches some technical support levels, that company is going to go out of my portfolio. So I don't like fall in love with any of the companies.
My follow-up to that, and as another question I have, is because when I look at your portfolio, you don't have the obvious names. You don't have the Microsoft and the Amazon and all that. You have smaller companies that if you are if you're doing this long enough, you recognize some of them. And some other of them, you say, okay, it's a bank in Italy. So when you're dealing with those smaller companies that they are not well known and they are not covered by the press, by the financial press, how do you get the news? Because I'm invested in Microsoft. If the CEO of Microsoft says something somewhere, we're going to know on Twitter. So how do you deal with getting around the information that you should be getting about smaller companies that they are not covered by the financial press?
So when I research a company, then the first thing I do is, I have like a few websites that I use. So I use like marketstrainer.com, I use ticker.com, and these websites will give you like all the basic facts about the company. Like what does it do? What are the financials for the past X years? What are the analysts saying about the company? What are the target prices? What are the earnings estimates?
The estimates.
What are the news about this company? Then what I will do is I will go to the investor relations website of the company. I will download the last of the quarterly earnings result, look at the presentations, what is the management saying about that. I will read the transcript of the last quarterly earnings call. And basically what I want to find out is what are the issues that the analysts are focusing on. I'm not going to become an expert on this company. I will always know less about the company than the analysts following it. But that's fine, because what I really want to understand is what is the problem with this company, and that you can find from those news articles and the analyst conference calls. I will also look at the chart of the company for the last 1 year or 2 years, and I will look at any days when it fell a lot, and then I will check like what was the reason for that fall, because there's always some news affecting that company or the sector.
Yes.
And then that's how I will determine what is the problem. And that's what I want to find out. Then after that, if I'm okay with the problem, then the stock goes into my portfolio. And then after that, it's just like the regular, like following the news. So there's like a number of platforms where you can add all of your stocks into kind of a virtual portfolio, and then you look at the news of that stock or of the portfolio into your email inbox. So then that's how you kind of like follow what's going on with the stock. Obviously, every day you will also look at the chart, what's happening with the stock. If it's going down for no good reason, you will become more cautious. You will try to find out what is the news affecting this company. Is there any news? Does somebody know something about this stock that I don't? And then sometimes you exit just because you get uncomfortable with how the stock is behaving.
If we look at practical cases, I see in your portfolio you have Verizon, Deutsche Telekom, and Vodafone, 3 big groups that are telecom groups that are in the US. And you mentioned that you pick your stocks when they are cheaper than the sector. But in this case, you picked practically the whole sector. There's only AT&T missing, and they have different dynamics. Verizon is basically a no-growth company. A lot of investors see it essentially as a bond because of its very high dividend yield, while the other ones are a bit more high growth. They have also more debt. So there's also a reasoning that with the interest rates going down, probably they will have less financial pressure on them, etc. But how did you do for this specific telecom sector, and why did you leave AT&T out of it, which is maybe the biggest one actually from that sector?
So this is like a more a macro bet actually than like a fundamental bet.
Okay.
So I don't have like a strong preference between like Verizon and AT&T, but now I want to keep the portfolio kind of the numbers like quite low. So I could kind of guess by both AT&T and Verizon because I don't have a preference. But now I just pick one of those. Like with Deutsche Telekom, what I think is that if you do a sum of the parts analysis of that one, then you find that the T-Mobile US stake that Deutsche Telekom has already accounts for the majority of the value of Deutsche Telekom, and then on top of that you get operations like elsewhere, like in Germany. So just on that basis, I think those shares are like reasonably valued, and then that's why that one is in the portfolio. But as you say, that's a bit more kind of a growth style play than some others.
So these are more than macro plays to some extent. But in the fundamental analysis that you make, do you only look at, so you look when a stock is cheap, why it's cheap? So if you're comfortable with the reasons why it's cheap, right? And the cheapness, you define it as cheapness relative to the sector, or is it cheap? Or do you also include some stocks are very cheap because there is no growth ahead, while some stocks are very expensive because they seem to be very high growth. Nvidia for the earnings times 40, right? While Verizon must be, I don't know, times, I don't know, maybe 4 or 5. Why did you not pick, for example, Nvidia, which clearly has tailwind? Uh, AI is a major macro play, and if you do that fundamental analysis, you would find out that Nvidia probably is the one with the best edge, right? So far it fits, but it wouldn't fit probably in that technical analysis that we're going to discuss how you do it, but probably it wouldn't, who knows, maybe it would actually, because there's a rising trend. Basically, why did you leave AI out of the picture and AI stocks like Nvidia? Well, what are the reasons? Why are they excluded from your triangle?
So technology stocks, I wish probably like any value investor that I had more of them in my portfolio, because they've obviously been the best performing sector since 2018. I mean, it has been super easy to make money in tech. You just had to buy the big names, hold, and that was it. But what I feel is that I don't have any edge over anybody else in those companies. They're followed by 20, 30, 40, 50 professional analysts. And all of these guys know more about these stocks than what I do. So, I mean, yes, I could like do like what a lot of other people do and just buy a few of these big safe names. You're not going to go too wrong with those ones. But I just don't feel like, I mean, so many other people are already doing that. So what's my kind of edge? Like over those other people then? Like, why am I in this game then? Like, if that's all what I'm doing. Now, I mean, that's not to say that it's probably been like a slight, I wouldn't say like mistake not to have like those stocks, but still, again, you have to be kind of open to new influence as well. Like even if you say that you're a value investor, you want to buy, let's say, low price to earnings, low PE ratio stocks, then maybe there's just some companies that they're just so good that actually it's worth paying up for them. So I've never been like very comfortable like paying high PE ratios for any company whatsoever. So right now, if like all these Apples and Nvidias are, 30p, some are like 50p, then like just based on that absolute level of the PE, I immediately I'm turned off. But maybe it's bias. Like it could well be that you should be more open to paying like a high PE ratio for like the very rare companies which are so good that they really deserve those premium valuations. So it's not really my style. I don't expect that, I'll be buying Nvidia anytime soon or like any other tech companies. So it's just not like philosophically what I'm comfortable doing or like psychologically what I'm comfortable doing. But at the same time, I really I applaud those people who been able to see what these companies have been able to do like from early on, and they've been steadfast in just holding them. Because obviously there's been many opportunities to sell them at the bad time as well. Like let's say end of 22, they were low, and maybe some people got scared and sold them. But if you just held, then you made lots of money. And I think that I really appreciate like that, like the kind of different point of view, like that some people have been able to see like the long-term future of these companies. So, so yeah.
Yeah, the Magnificent Seven have been always, not always, the last 15, 20 years for sure, they have been expensive. I mean, if you are a value investor, by the definition of Buffett, then you're not touching them by that definition. But a transition happened from the value investor of the 60s, 70s, and 80s to the early 2000s and 2020s. You can't just go, okay, 10 times price to earnings, and if it's more than that, I'm not buying. If you're going by that, then you don't have it in your portfolio. especially in good times. You're only gonna have some companies that they grow, but you're missing the performance of the Max 7. And another thing I wanted to ask you, you're not a big fan of Asian stocks, correct?
Asian stocks. It's simply because of the time zone. So I used to live in London before moving to Dubai, and trading Asian stocks from London was a nightmare because you have to wake up in the middle of the night. So just for a very practical reason, I like to sleep late. So waking up at 6 a.m. like to trade Asia, it just wasn't my cup of tea. So that's why I really preferred the European market and the US market.
Yeah, waking up in the morning and seeing stock down 5% and you don't know what happened. Yeah, it's not a pleasant surprise to have every now and then. Akim,
You do have some Asian family, right? So
yes, my wife is originally from Singapore.
From Singapore, okay. Did you ever live there in Singapore, or you
I've
personally
visited a number of times, but I never lived
a couple
there.
times?
Yeah.
But the Asian stocks, it's something that, let's say, you feel that you have the knowledge. It's just for practical time. Is really just for the time zone, or are you not? Will Asian assets ever integrate your portfolio? Let's put it this way.
I don't rule it out. If, let's say, they were significantly cheaper than European or US assets, then certainly I would start to look into them more carefully. Now, a big part of the Asian market is China. On China, I am strategically cautious. So China probably is not going to form a big part of my portfolio for the next few years, at least unless the geopolitical tensions between China and the West go down, because I just don't like the tail risks that come with like a big allocation to China.
So basically, you cannot put a check on China for your first macro filter, right? The China overall just doesn't satisfy your macro requirements, if I understand right.
That's exactly right.
And if we can...
Some questionable numbers sometimes about China. You get one story from the Western media, and then you get a different story from their local media, and then you're sitting 3 time zones away trying to make sense which one is true and which one is not. Yeah, it's one of the reasons that I try to avoid Asia as well. It's
complicated.
It's tricky to get Asia correct,
to say the least. Yes. Pietari, so we went through the 2 filters already, macro and the fundamental analysis. The last one is technical analysis. Tell us about it. Are you waiting for a dip to buy, or what kind of technical parameters do you use once you have selected the geography, the sector, and the stocks? What are you waiting for in terms of technical signals to add the said asset, or to remove the asset from your portfolio? Do you use technical analysis for both buying and selling?
It's more for selling. So when I hold some positions in my portfolio, then it's mostly to control the risk, such that if a position reaches some technical support levels, which I see from the chart, then I might sell it. And the reason for that is that then I will become cautious about the fact that maybe somebody knows something about that company which I don't know, and that's why they are selling. That's why the share price is going down, and then I will also become more cautious. Sometimes it works, sometimes it doesn't. It's more like a risk control measure. Sometimes I will also apply this at the kind of more market level. This is like more rare, but let's say like in the times of COVID, for example. So the market was crashing, and then you just get like a big loss very quickly, and then you start to think that, okay, what do I do now? And in part because of then your kind of macro view, and maybe in part because of the technical loss, you will sort of kind of reduce your risk. But I mean, it's always kind of situation and context dependent, like what you are going to do. So there is no like fixed rules that I use, and the technical analysis is not like the most important element of my strategy. Okay, but it's just like sometimes to kind of control the risk, exit some positions, maybe not to take like bigger losses like that.
So you basically sell, or you at least tempted to sell from a technical analysis point of view when there is the start of a downtrend in an asset. So do you use, for example, stop losses? Do you say, that stock is down 10%, let's just remove it?
So interestingly, I don't use stop losses at all. So this is all a completely manual process. So I look at my portfolio every day. If some stock is going down, then I will look at the chart and I'll see if it's maybe breaching some level. So the reason I don't use stop losses is that I'm really fearful that one day there's going to be a repeat of Black Monday, which was a famous day in 1987 when stocks fell more than 20% in one day. And there's multiple triggers for this type of event. In 1987, interestingly, there was no trigger for it. It was just like almost like a random event, which was then exacerbated or made worse by program selling. But there was no like, fundamental reason for that 23% loss. So even for no reason, the stock market can suddenly fall 23%. I find it quite fascinating. But like imagine if there was some real event happening, like let's say a local nuclear war starts, let's say between two nuclear powers, couple of nuclear warheads go off somewhere. I mean, that is the kind of event which will cause an immediate drop of more than 23% in the overall market. Probably the market could easily fall 30–40% immediately. And then in this type of situation, all of your stop losses would trigger at the same time. You would have no control over what would be happening to your portfolio. And it's just a paid risk that I don't want to take. So in this type of situation, you would like to control the portfolio manually. And then maybe sell the stocks which you think are kind of doing better than what they should be doing, than buying some stocks which are doing worse than what they should be doing. And on these kind of days, there's potential for massive outperformance to be generated if you can do it like this kind of thing, like correctly. But to have it done automatically by a computer to go 100% into cash, I don't think that's not what I would like to see on that kind of day.
Yeah, because sometimes the market is down, and the problem is not with the individual stock. The problem is with the Fed or with the government or with a lockdown or with whatever the case may be, and the market just goes down altogether. And if you have your stop losses, it's just going to activate by themselves, and then you just got out, and then you have to get back in. The same thing with 1987. I mean, I believe the market came back quite fast after the 1987 23% down in a single day. So, I mean, investing comes down to a judgment. You have to make a judgment in buying and selling. You can't just, okay, I'm going to buy here and it's going to be an automatic stop loss or an automatic take profits. That's not how it works. You have to make a judgment. You have to make a decision. Am I comfortable with this, or am I getting out, or am I?
Yes, and in general, I'm not like a big fan of stop losses at the portfolio level either. So on eToro, you can set a stop loss when you copy other people, but I find it's a bit dangerous because if you set it at too high a level, then let's say there's a market downturn and stocks go down, 30%, 40%, 50%, which will always come like at some point, like this kind of downturns. So then you might have a stop loss set at, let's say, 30%. But actually, after that 30% loss and after getting triggered on that stop loss, probably like all the stocks have become cheap at that time, and then it would actually be a better time to buy rather than sell. So then that stop loss, yes, it kind of protects you from losses beyond the 30%, but actually in the longer run, it turns out to be counterproductive. So there should be some kind of like a relative stop loss, such that if the person loses 30% relative to the market, then maybe that's when you want to get stopped out, but not just because like everybody is losing 30% and this person also lost 30%.
Yeah, I'm the same way. I don't use stop losses whatsoever. It has to be my decision. I watch my portfolio daily. I only have 20 something individual positions. I don't have 50, so I know what's going on. I can follow the news, the earnings, and all that. And I mean, it's your job to make a decision. Okay, I'm selling, I'm buying, I'm holding. If you can't just do that, then you're gonna rely on stop losses. Then it's a different. Then you're not an active investor. Then you're just relying on the. Then it's something different, in my opinion, at least. But I agree with you. The stop loss is sometimes gets you in more trouble than it helps.
We have a couple of minutes left, and I wanted to ask actually one question. I don't know, Dimitri, if you had still something that you wanted to ask Pietari about this topic. You do? Go ahead then.
No, you go first.
Because mine is a slightly different topic, actually. Slightly off topic.
Okay, so I have another question on technical. So let's say the macro is favorable to the camp, because I'm guessing you're not starting with the chart. So you're looking into a company, the chart and the price is the last thing that you're gonna look, correct? First, it's just one layer of the onion at a time. So you start with the macro, it fits into your macro view, and then the fundamentals, and then you see the technicals, they are not favorable at all. What do you do?
So then I will wait for the technicals to stabilize. Like sometimes I find a company which I really like, but the stock chart shows that it's just falling. It just keeps falling. Then I will want to see some stability in the chart before buying it. So yes, okay, sometimes, like rarely, I use like the chart even to kind of decide when to buy. But maybe you wouldn't really call this like technical analysis. It's more like, I don't know what you would call it.
Avoiding falling knives, probably,
Yeah.
right?
Yeah, so it's
Something like
no
that.
compromise in your strategy. Everything has to be correct, and maybe not every single time. I'm sure there's an exception to every rule, but your procedure, it goes like that, and if one part is missing, then it's a no for you, correct?
Yes, that's right. Yeah, like all those like three angles must align together.
Okay.
I had one question. And forgive me because it's a little bit provocative, but I always ask at least one provocative question. I told that to Dimitri before this call. I would be tempted to copy a portfolio, right? I'm a popular investor as well, so and Dimitri as well. So I cannot do it, but I actually would be very tempted because you're obviously smart and your strategy makes a lot of sense and your performance confirms that. But I am located in a jurisdiction, which is Luxembourg, where I am taxed a bit more than 40%, 42% on capital gains made on positions that are held less than 6 months. And a lot of countries have similar rules. In Germany, I believe it's 1 year. If you hold your position less than 1 year, you have to approximately pay also half of the profit. And a lot of jurisdictions are structured that way, where you're heavily taxed on positions you don't hold for long. You trade a lot, actually. Your average holding time is 2 months. And the last 30 days, you closed 200 positions. The last 7 days, you closed 100 positions. So if I was a copier, I would incur an important tax liability. Do you have the plan to trade less over time, do you think this somehow could affect the performance if you were just holding for a bit longer? And for the next few years, now that we're entering a new phase of the cycle, are you planning to hold for longer term the positions that you open now, and now that your reallocation seems to have been more or less completed because you don't have much cash, available cash left? So I assume you were making a reallocation here. Tell us about this part, the tax liability that copiers can incur.
Yeah, so my holding period has historically been around this level, kind of 2 months, maybe 3 months on average. It's always been like that. And I find it works for me because it's the kind of holding period which not a lot of other people have, I find. So I find like I face a little bit less competition in the markets with this holding period than if my holding period was, let's say, a couple of years, which is kind of more typical for a value investor. So sometimes when I say that I'm a value investor, then people don't believe me because they see that, okay, my holding period is 2 months. So they say that you're a macro investor. And it's true that in part, I am a macro investor. It's like part value, part macro. But I don't have any plans to like change this holding period because then I find it would compromise my strategy. I could potentially like hold for about 6 months or so because typically these macro trends, they don't change like all the time. So I've been able to be in the banks since for about 1 year now, for example. So if I was optimizing it for taxes in certain jurisdictions, then yes, I could buy some banks in like, let's say, May 2023. And then now 1 year later, now, okay, I've kind of changed my opinion. I want to get out of banks. So now I would then be selling the stuff that I bought back in 2023, thus reducing the tax liabilities. But I do find that I can kind of manage the portfolio within the sector by changing the stocks a little bit every few months. So I always want to be the cheapest stocks within the sector. And my opinion about what are the cheapest stocks, it changes not infrequently because it depends on news flow. So typically stocks become temporarily cheaper if there's some bad news about the company. So then I will maybe buy the stock after it fell because of some bad news. But which companies have bad news, it constantly changes. So that's why there's turnover in this strategy. And I think, to be honest, I think it's always going to be like that. So if you copy this strategy, then you have to you just have to live with the turnover and the tax liability that come with it.
What you're saying between the lines is that the triangular strategy, if I may call it this way, the triangular strategy is not compatible with long-term investing? Or do you think that someone, for example, an investor who's been listening to us and he or she is thinking about his or her own strategy and is very inspired by your 3 angles and by the way you do it, but he or she wants to hold for a long period of time to avoid tax liability, but also to avoid perhaps the headache of having to be too active as well. Is it really incompatible, triangular investing with long-term holding?
Some of it is, and some of it isn't. So the macro part is compatible because the macro view tends to change relatively infrequently. The quantitative, like the fundamental analysis part, it's 50% compatible because like I do kind of change my opinion about the fundamental of the companies like a bit more frequently than once a year. Okay, I mean, yes, sometimes it can be once a year, but like sometimes not. So that's 50-50. Okay, then the technical analysis part is not compatible with 1 year holding periods because technical analysis, it can happen at any time. The stock can reach technical support level at any time whatsoever. So if you wanted to make this strategy such that you hold for longer time periods, then you could definitely take the macro part, like 100%, and then the fundamental part, yes, but in a bit less active modified form.
So basically what you're saying is that you're not taking into consideration the taxation for your holding period. Whatever works for your strategy works. And if it's long, is long. If it's short, is short, and everything in between. As long you're being successful with your strategy, then let the chips may where they may. Okay, I have another question. It's a little provocative as well. I don't want to put you in the spot, but in the 3 of us, you are the most successful in terms of the management and careers and followers and your knowledge, that. So I'm sure you are active on eToro as well. Maybe you're not posting as much as other people, but I'm sure you sometimes you go through people's profiles, you read a post and you say, okay, that's interesting. Let me look him up. what are some of the red flags that immediately trigger you and say, okay, this guy doesn't know what he's talking about, or this guy is a fraud? What's some of the red flags that you say, okay, this is suspicious, this doesn't look right?
Okay, so the first red flag is like if somebody targets returns which are too high. So if I see on the profile that, you know, this guy is targeting 25% annual returns, for example, then I will immediately think that this guy has no credibility. Like Warren Buffett, who's the most famous investor in the world, his long-term track record is 20% a year. So if you're targeting 25% returns a year, either you are taking completely excessive risks, or you're saying that you're a better investor than Warren Buffett. So you immediately lose credibility by saying that. Like we also know from academic research perfectly well, like how much the stock market returns every year, and that's nowhere close to even 20% a year. Is less than 10% a year that the stock market can be expected to return, and very few people outperform the stock market in the long run. So that is the first thing that immediately kind of says that, you know, this person is not professional.
Yes.
Then the second thing I don't really like is that when people trumpet their track record, their long-term past performance like too much. So yes, it's important. I mean, that is why we are in this game. But also, if you look at the track record, there's a saying there below it that past performance is not indicative of future performance. And that is because academic studies have found that this is more or less correct. It's about 95% correct. So you have to be very careful about talking about your past performance, in the sense that in many cases, the past performance is about the kind of sectors that you were in. Like you can see even long-term track records, which are excellent, which have simply come about because of heavy bet in tech. And anybody would have got a massive track record over the past 10 years by going long the Nasdaq, basically.
Yes.
You could have done a passive investment in the Nasdaq, and you would have a great track record. So yes, it's great to have a great track record, but you also have to talk a little bit about how was the track record made. So in general, I find that if there's like too much positivity and kind of not enough kind of caution about what you have accomplished, then that's the thing that I don't like.
Yes, I agree.
I mean, that's a fantastic conclusion, I think, Pietari. It's actually the fact that you're reasonable is refreshing. There are not that many reasonable people. I mean, I don't know if it's a disappearing species. And that's why we really wanted to have you on this podcast, so that you can share there's really a lot of wisdom that we can take from this episode and from listening to you. So Pietari, again, thank you for joining our podcast. Let's talk. We will put links to your eToro profile and to your website. You have also an interesting website where you publish there also some articles and some more insights on your strategy. So thanks a lot for joining. Guys, don't forget to follow our show, to put a little rating on the episode. And if you have any question for Pietari, there's a Q&A that you can write down your questions, and we'll make sure to forward them to Pietari and to post the answers there. So thanks a lot, Pietari, for joining.
Thank you, Pietari.
Thanks for having me.
Thank you for your time.
Thank you, guys. Bye-bye.
Bye.
Bye.